Chapter 1, Regulation of the Primary Market. Video 6, Transactions Exempt from Registration. In this video, we'll explain what an exempt transaction is and review examples of several types. Issuers may be relieved of their registration requirements of their securities based on the type of transaction involved. In other words, a security itself may not be exempt from registration, but because of the transaction, it will not be required to be registered with the SEC. The exempt transactions that we'll be discussing are Regulation D, private investments in public equity, called PIPES, P-I-P-E-S, Rule 144, Rule 144A, Rule 147, and Regulation Crowdfunding. Most private placements are sold under Regulation D. These transactions are exempt when offered to no more than 35 non-accredited investors. There are no restrictions on the number of accredited investors that can be involved in the sale. The SEC defines an accredited investor under Rule 501 and includes any of the following: natural persons with individual or joint net worth of $1 million or an annual income of $200,000 for the past 2 years, or a couple including spousal equivalents with joint income of $300,000. An officer or director of the issuer. Any bank, investment company, and insurance company regardless of assets. Institutional investors with assets in excess of $5 million, and any individual holding a Series 7, 65, or 82 license. An investment advisor, rural business investment companies, RBICs, or an employee of private funds if deemed knowledgeable. Spousal equivalents are partners that are not married but have essentially the same relationship as a married couple. To promote small business formation, the offering limits under Reg D were increased. Under Rule 504, the offering maximum is $10 million in a 12-month period, and purchasers receive restricted stock. The lockup agreement prohibits the resale of these shares in the secondary market for a minimum of 6 months. There is a restricted legend on the face of the certificate, and the stock cannot be resold until it is removed. There are no limits on the types of retail investors that can be involved. Offerings greater than $10 million in a 90-day calendar period are covered under Rule 506. Investors still receive restricted stock. Under 506, the offering can be made to a maximum of 35 non-accredited investors, and any non-accredited investors must be sophisticated and able to evaluate the risks and merits involved. Advertising restrictions apply if the offering is made to non-accredited investors. But if the offering is made solely to accredited investors, then advertising is permitted. Even though the issue is exempt from registration and prospectus requirements, full disclosure to investors must still be given to investors through an offering circular, which can also be called an offering memorandum, or PPM, Private Placement Memorandum. Another way for public companies to raise additional capital is through PIPE, P-I-P-E transactions. These are private placements known as private investment in public equity. This allows investors to sell their shares once they're registered and allows the issuer to raise capital prior to registration of the offering. Since private placements were never registered, those restricted shares cannot be resold to the public without registering or finding an exemption to sell under. The three options are to sell privately, register the shares, or use Rule 144. The first two options are straightforward, so let's look closer at Rule 144. The first requirement is the seller must meet the lockup requirements. Typically, the stock is restricted from resale for 6 months, but that holding period is extended to 1 year for securities of companies that do not report to the SEC. Rule 144 allows the holder of restricted shares to sell them publicly if the issuer has registered shares outstanding and is current with its SEC filings. The seller will file Form 144 with the SEC at or prior to the sale date. The seller must have held the securities fully paid for at least 6 months. It cannot be done more than 4 times per year, so every 3 months, and the maximum sale under each Form 144 is the greater of 1% of the outstanding shares of the company, or the weekly average of the 4 weeks trading volume preceding the filing of the Form 144. The volume restrictions under Rule 144 are remembered with the 144. The maximum sale is the greater of 1% of the outstanding shares of the company, or the average of the last 4 weeks trading volume, and this can only be done 4 times a year, so every 3 months or 90 days. Form 144 does not need to be filed if the sale meets the de minimis exemption. The exemption is for 5,000 or fewer shares, or the dollar amount is $50,000 or less. Aside from restricted stock, Rule 144 is also extended to include control stock. This includes stock held by an officer, director, 10% shareholder, or affiliated person. Control persons tend to hold large amounts of stock, and a fast sale of a holding could severely depress the market price of the stock. Therefore, control stock is subject to the dribble rule, taking extremely large shareholders years to completely sell their position. However, there is no 6-month holding period requirement. Restricted stock is unregistered and subject to both holding period and volume restrictions, and control stock is registered and only subject to volume restrictions. The dribble rule applies for both restricted stock and control stock. Don't confuse 144A with Rule 144. It is not the same rule. Rule 144A was enacted to allow large institutional purchasers to trade unregistered securities in the U.S. So let's start by defining a qualified institutional buyer. A QIB is an institutional investor that owns and invests at least $100 million in securities on a discretionary basis. Rule 144A transactions have some restrictions. Initial purchases must equal $500,000 or more, and once purchased, the securities can be traded without restriction between qualified institutional buyers. These securities trade on a trading platform called Portal, and the securities can never be publicly traded unless registered. Rule 147 is the exemption for intrastate offerings. Under this rule, all purchasers must be in-state residents, and issuers must meet one of the following requirements. 80% of the issuer's gross revenues must come from business activities within the state. 80% of the issuer's asset must be located within the state. 80% of the net proceeds from the offering must be used within the state, or a majority of the issuer's employees must be based within the state. Under a newer rule, Regulation 147A, an issuer who is incorporated in one state but whose business is primarily conducted in another state is allowed to make offers and sales of securities to residents in the issuer's primary place of business. Securities purchased under 147 or 147A may not be resold outside of the state for 6 months. Appropriate disclosures must be made on the limitations of resale, and the certificates must contain a legend containing the restrictions. These securities must still be registered under state laws. Regulation crowdfunding allows small startup companies to raise capital through private placement of unregistered securities. Companies are allowed an exemption from registration if the offering is $5 million or less of their securities. Under this regulation, there are income-based or net worth-based limitations on the amounts non-accredited investors can purchase in a 12-month period. The limitations are the greater of their net worth or annual income over a 12-month period. Accredited investors have no limitations. All purchasers are subject to a 12-month lockup on resales of these securities. Investors wanting to participate in crowdfunding opportunities make purchases through an online platform of a FINRA-registered broker-dealer or a specific funding portal that is registered with FINRA. Issuers are exempt from prospectus requirements, but still must provide investors with certain disclosures, including company information, risks involved, security price, and names of officers and large shareholders.